All right, welcome to The Explainer. Today, we're going to break down a really powerful concept that helps traders figure out the perfect price to get in or out of a trade. It's all about learning to see the market for what it is, what's expensive, and what's a total bargain.
So, let's just kick things off with a question that, let's be honest, every single one of us has asked. You see the price shooting up, you jump in thinking it's going to the moon, and bam! It immediately reverses. It's so frustrating, right? But what if there was a way to look at the market that helps you avoid that trap? You know, at the end of the day, all profit, doesn't matter if you're trading, flipping real estate, you name it, it all comes down to this one simple, timeless rule. Now, it sounds completely obvious, but actually doing it when a chart is moving a million miles an hour, that's the real trick. The source material for this explainer just nails it with this question. Think about it, you'd never buy something when it's at its most expensive point ever. Your gut tells you to wait for a dip, for a sale, for, well, a discount. And that is the exact same logic we're about to apply to trading. Okay, so let's get into the nitty-gritty. To actually use the buy low, sell high rule, we need a way to define what is low and what is high on a chart, right now. And that's where this idea of the dealing range comes in. Think of it as our map of the market.
Just imagine any big price move can be sliced into three zones. The top half, that's what we call the premium zone. It's expensive up there. The bottom half is the discount zone. That's where things are cheap. And that line smack in the middle, that's equilibrium, the fair price.
So this specific chunk of price action that we're looking at, from a key low up to a key high, or the other way around, that's what traders call the dealing range. This is our playing field. It's the entire context for the decisions we're about to make. So here's the absolute key takeaway. Once we've drawn our dealing range, our job gets super simple. We are only looking for reasons to sell when the price is up in that premium zone, and we're only looking for reasons to buy when it's down in the discount zone. We pretty much ignore everything in the middle.
All right, theory is one thing, but let's make this real. We're going to walk through step by step how you can actually use this. First up, let's look at how to spot when a nice, strong uptrend might be running out of gas and getting ready to turn over.
So, we start with a market that's clearly on its way up. You can see it on the chart. It's making that classic staircase pattern, right? Each peak is higher than the last one, and each little valley is also higher than the one before it. That's our bullish setup.
Okay, here is the exact playbook for catching this reversal. Step 1, spot the high. The market pushes up and takes out a previous peak, grabbing what traders call liquidity. Step 2, and this is the big one, spot the low. Price crashes down and breaks below the last important low that pushed the price up to that high. This is the signal. The structure has shifted. Step 3, draw the range. Now we just connect that high from step 1 to the new low from step 2. That's our new dealing range. And now for step 4, we just sit back and wait for the price to rally back up into that expensive premium zone to look for our sell.
And this quote right here, it highlights the most critical make-or-break rule of this whole thing. It is so easy to pick the wrong spot on your chart. The low you have to find, the only one that matters, is the one that was the launch pad for that final high. Getting this right is everything.
Okay, so we've covered the bearish side of things. Now let's flip the whole thing on its head. We'll look at the exact opposite scenario, how this works when a downtrend is looking like it might finally be over. And you'll see the logic is a perfect mirror image.
So here, we start by watching a market that's just been falling and falling. We see that pattern of lower lows and lower highs. It's clear the sellers are in charge, and the trend is down.
And again, it's that same four-step process. The market makes a new low. Then, here comes the signal. Price rallies up and breaks above the high that was responsible for that last low. Boom, market structure shift. Now we define our new dealing range from the bottom of that move to the top. And then we wait. We wait for a pullback into our cheap discount zone to look for a chance to buy.
Of course, we all know that real-world charts are rarely so perfectly clean and simple. So, before you run off and start drawing these ranges, let's hit pause and do a really important reality check. We need to cover some of the trickier scenarios and warnings you have to know.
This is probably the most important thing to remember. The source material is crystal clear on this point. Using premium and discount is a tool for confirmation. It helps you add weight to a trade idea you already have. It is not a magic crystal ball that's just going to tell you the future.
You know, sometimes the market does something a little sneaky. It'll push just a tiny bit past a really obvious low or high, hitting all the stop-loss orders that people have placed there, and then it'll snap right back in the other direction. That's a stop hunt, and it's basically designed to trap people. Now what's really cool about this slide is it shows that stop hunt in action. See, in a normal reversal, the price will come down into the discount zone and that original low of your range holds. But in what we call a deep discount reversal, the price will actually dip below that low first, do the stop hunt, and then start the real move up. Understanding this can save you from getting kicked out of a perfectly good trade idea. Okay, let's wrap all those reality checks up into our final takeaways. Number 1, always use this as a confirmation tool, not a prediction machine. Number 2, if a dealing range looks gigantic or just choppy and messy, the smart money often just stays away. 3, your success with this lives and dies by how well you can identify the correct high and low. You have to practice this over and over. And finally, never forget that a big news event or a sudden burst of volatility can just throw everything for a loop.
So look, this whole framework is incredibly powerful. It gives you a map. It tells you where on the chart you should even be thinking about buying or selling. But that leaves us with one last massive question to think about. Knowing the right place is only half the battle. The other half is knowing the right time.